Hi everyone, welcome to my channel. So in this video, we are continuing our discussion about the different types of dividends. So in the previous video, we had discussed about the three types of cash dividends, that is regular cash dividend, then special, extra or irregular cash dividend, and we also discussed about liquidating dividends. So in this video, we are continuing the discussion about the other two types of dividends, that is stock dividend and stock split. We would also study about reverse stock split. Okay, so without wasting any time, we can move forward with understanding what is a stock dividend. So what is a stock dividend? It is a non-cash form of stock dividend is a non-cash form of dividend. As the name suggests, it's a stock dividend. So non-cash form of form of dividend, and some other names for stock dividend is as per curriculum. Some other names for stock dividend is bonus issue. Then curriculum says script issue is also another name, and script dividend. Script dividend. So actually, though similar to bonus issue, script dividends usually give the shareholders a choice to select between a cash dividend and a stock dividend. Whereas when it comes to bonus issue, there is no choice. All shareholders would receive the bonus issued. Whereas in the case of scrip dividend, usually there is a choice provided to the shareholders between cash dividend and stock dividend. But as per curriculum, bonus issue and scrip dividend are other names of stock dividend. Okay. So now let us understand, like I'll write down what a stock dividend is in terms of words. So if a company distributes additional shares, if company, not if, so company distributes additional shares of its common stock to shareholders instead of cash. So instead of cash dividend, the company is going to distribute additional shares to the shareholders. So that's why it is known as stock dividend. So this is usually 2 to 10%. Usually 2 to 10% of shares outstanding. Okay. Now, what is the benefit? So, one of the benefit is, or one of the benefit of stock dividend is the cost per share reduces. Cost per share would reduce, but the total cost base remains the same. Total cost base remains the same. So if cost per share reduce, it increases float. That's the advantage. So total cost base remains the same. So I'll clarify it with the help of an example. So if a shareholder has 1,000 shares, so if a shareholder has 1,000 shares, and the price per share is so rupees 10 per share is the price. So then what is the total cost base? The total cost base is 1,000 into 10, that is 10,000. So rupees 10,000 is the shareholders total cost base. Okay, now uh, after a 10% stock dividend, so after a 10% stock dividend, what will happen is that a 10% stock dividend means that uh, 10% additional shares the shareholder would receive. So if the shareholder has 1,000 shares, now the shareholder will get a 10% more shares. That is, now it would be equal to 10% of 1,000 is 100, right? So 1,100 shares total. Now the shareholder will have total 1,100 shares. But even though the shareholder would have 1,100 shares, the total cost base is going to remain the same. So the total cost base is going to remain 10,000. So from this 10,000 and from this 1,100 shares, we can get the price per share, which would be rupees 10,000 divided by 1,100, which would be equal to now rupees 9.09 per share. So that's why after a stock dividend is um, paid, after a stock dividend is given out, the shares would increase. The number of shares that the shareholder has increases, but the total cost base remains the same. And because the total cost base remains the same, from that you can calculate the price per share. So price per share would decrease after stock dividend, but the total cost base would remain the same. Okay, so now we understood stock dividends with the help of an example. So now what is another benefit of stock dividend? So stock dividends are generally not taxable. Just think, why is that? So stock dividends are generally not taxable. Why is that? So if you're receiving additional shares but the total cost base remains the same, are you actually receiving any cash or any income from it? No, right? So stock dividend is actually, in simple terms, merely dividing a pie into smaller pieces. Dividing a pie into smaller pieces. That's what stock dividend actually is. Smaller pieces. That's why, since you're not actually getting any cash or an income, it is generally not taxable. Okay, so stock dividends also it does not affect the shareholders proportionate ownership, because this is bonus issue, right? So every shareholder is receiving the same amount of bonus shares, so it does not affect shareholders proportionate proportionate ownership. It means that it is same as telling it does not change shareholders ownership position. It, in simple term, it says that it does not change shareholders proportionate ownership. Okay, so one important point that I had missed to mention in the previous video as well as this video is that in this chapter, in this chapter, we are considering common shares. Common shares are being considered, is being discussed, and not preferred shares. This is applicable to the previous video as well, not preferred shares. So all the discussion is such that we are talking about common shares and not preferred shares. Okay. Now we understood that stock dividends don't change shareholders ownership percentage. Now let us actually now let us actually study about other advantages. So some other advantages are payment of stock dividend increases stocks float. So payment of stock dividends increases stocks float. Payment of stock dividend increases stocks float. That is actually what is happening when you're issuing stock dividend. If you see, the price of the share is decreasing, right? So if the price of the share decreases, it means that it can be it increases the stocks float. That is, traders can easily trade it, and in like, since the price is less, it's more like more trading would be taking place and it's easier to trade. So that's why the payment of stock dividend increases stocks float, which is a good thing. It also improves liquidity because uh, of the lower price, trading would increase, so it improves liquidity. Not only that, there is no cash payment taking place, so there is no cash going out of company's books, so assets are not getting affected. So in that way also it improves liquidity. Now it dampens share price volatility. Share price volatility. And there is a traditional belief that lower the share price, more investors would come in. That is because, like, if you are uh, like, I'll take the example. So if you are an investor with rupees 1 lakh uh, investment capital, if a share price is rupees 10,000, you will, if you are going to buy it, it would mean that uh, 10% of your investment capital is being blocked by this one share. So it's not that the investor would be hesitant to make that investment, right? But if it is in the range of rupees 100, it would be easier to invest, because it won't take 10%. Like, shareholder can think about investing instead of 10,000, the shareholder can think about investing probably 4,000 or 5,000 rupees. So that's why traditional belief is that lower the share price, uh, lower share price, okay, 1 minute, attracts more investors. Lower share price attracts more investors, because investors, if the price is lower, it is investors can decide on the investment, how much investment to be made. Like, instead of 10% of a investor being stuck with one share, instead, like in our example, 10,000 rupees, instead of investing rupees 10,000, which is 10% of investors capital, investment capital, investor can decide on investing 4,000 or 5,000 rupees. So US companies view optimal range as view optimal share price range as rupees 20 to rupees 80. Okay. Now, since we discussed about uh, stock dividend, we can compare it with cash dividend. So, comparison. So, what is the difference? So, I'll have cash dividend this side, and I'll have stock dividend on this side, and I'll compare. So, the first point is cash dividend would affect a company's capital structure. Why? Because cash is being paid out, assets are decreasing. So, affects companies' capital structure. Okay. Whereas in the case of stock dividend, is there any impact? No economic impact, because no cash or uh, no amount, no asset is going out of company's books. So, no economic impact. That's the first difference. Second, reduce asset, because cash paid out. Similar to the first point, in the case of in the case of stock dividend, do not affect, do not affect shareholder equity. Okay. Now the third point is, okay, second point here it is telling, because stock dividend is being paid out, those shareholders would get additional shares. It won't affect shareholders' ownership position. So here, if I come to this side, it reduce shareholder equity. Reduce shareholder equity. How? By reducing the retained earning. Equity value by reducing retained earning. Okay. Now, in this case, also, for stock dividend also retained earning are being retained earning reduces, but retained earning reduce because the stock dividend payment is being reflected at retained earnings, and retained earning would reduce by that amount. So retained earning reduce by the value of stock dividend payment, stock dividend paid, but but contributed capital increases by the same amount. But contributed capital contributed capital increase. I'll keep it in the same page. Increase increase by the same amount. So here retained earning reduce and hence the equity value would reduce. Here also retained earning would reduce, but it will go into the contributed capital section, and hence there is no change in the shareholders equity value. Now, the next important point is for cash dividend, and here stock dividend. So in this case, I am also writing stock split for these two points. Stock split uh, is also having the same effect. So in the case of cash dividend, uh, liquid liquidity ratio is affected. Liquidity liquidity ratio is affected because cash reduces. Affected. So liquidity ratio decreases because of decrease in cash, whereas in the case of stock dividend and stock split, no change in liquidity ratio and leverage ratio. Uh, but when it comes to cash dividend, liquidity ratio decreases and financial leverage ratio increases because cash decreases. Financial leverage ratio, that is debt to asset ratio. So in this, because debt to an example of financial leverage ratio is debt to asset ratio. So assets reduce, so the financial leverage ratio increases. Okay, so that's it. Just to give an example of liquidity ratio, I will write liquidity ratio. Example, I'll take current ratio, which is equal to current asset by current liability. So what will happen is that uh, liquidity ratio decrease. Why? Because asset reduces, because cash is reducing, right? So that's why current ratio reduces, that is liquidity ratio reduces. Similarly, an example of financial leverage ratio is, example is debt to asset ratio. As the name suggests, here it is equal to total debt divided by total asset. So since assets reduce, debt, this ratio would be increasing. That's why financial leverage ratio would increase. Okay. So in the case of liquidity ratio and financial leverage ratio, cash dividends affect it, whereas stock dividend and stock split won't affect it. So these points, we are only taking stock dividends into consideration for economic impact, retained earning impact, etc. But for the liquidity ratio and leverage ratio impact, it is same for stock split as well, like no change. Now, that's all for stock dividend discussion. Now, let us understand what is a stock split. So, the fifth type of dividend is stock split. Okay, so what is a stock split? Again, stock split also has no economic effect on the company, no economic effect on company, and shareholder total cost base and shareholders total cost base does not change. Shareholders total cost base does not change. Okay. Now, an example of stock split would be 241 stock split. 241 stock split. Now, based on the name, can you identify what this is? So, 241 stock split means that for every one share held, now you will have two shares. So, it means that if you own one share, after stock split, you will have two share. So this is similar to 100% stock dividend. Similar to 100% stock dividend. Okay? Because it's 100% stock dividend also, if you have one share, after 100% stock dividend, you will get two share. Right? Now, what is the effect of 241 stock split? The effect, I'm continuing with this example itself. One minute. Yeah, I'm continuing with this example itself. So the effect would be earning per share would decline by half. So earning per share would uh, decline by half because the number of shares has now doubled, right? So earning per share will decline by half. Price per share would also dec- be halved, so decline by half. That's why the PE ratio, hence the PE ratio, that is price to earning per share ratio, that is price to earning per share ratio, it will be the same. It won't change. No change. Why? Because uh, this is also getting divided by 2. This is also getting divided by 2. So the uh, ratio of PE remains the same. No change. Okay. So shareholder wealth is not changed after stock split. So this means that shareholder wealth is not changed after stock split because price to earning ratio remains the same. Okay, so here we have in this example we have a 241 stock split. So since it is a 241 stock split, they have given us the data before split and we have to calculate the data after split. So 241 stock split. So if you have one share, now you will have two share. So it's doubling. So before split, the number of share outstanding for the company was 2 million. Now uh, it would be equal to, after the split, it would be equal to 2 into 2 million, which is equal to 4 million. So the number of shares outstanding would be 4 million. Now the stock price. The stock price before split was $20. Now since the number of shares have doubled, the stock price will half. So now it would be $10 per share because earlier it was $20 per share, but now the number of shares have doubled. So 20 by 2. $20 divided by 2 will give you $10. That is the stock price. Earning per share was $1.5. So again, earning per share will also divide by 2 because it's 241 stock split. So now 1.5 divided by 2, earning per share would be equal to $0.75. Dividend per share will also half, so per share. So now it would be 0.5 by 2. So dividend per share would now be 0.25 dollars. Now dividend payout ratio. So dividend payout ratio is dividend divided by earning per share. So in this case, before split, the dividend was 0.5 and earning per share is equal to 1.5. So dividend payout ratio would be 0.5 by 1.5, which is equal to 1 by 3. Now in the case of after split scenario, here also the dividend paid is equal to 0.25 and earning per share is equal to 0.75. So this is also equal to 1 by 3. So the dividend payout ratio also remains the same. Now let us look at dividend yield. So dividend yield is dividend divided by share price. So again, before split, dividend is 0.5, and in this case share price is $20, right? Stock price is $20. So divided by 20, which is equal to 2.5%. Now if you look over here, what is the dividend? Dividend is 0.25 and the new share price is $10 per share. So $10, which would be equal to same 2.5%. Okay. Now after that, if you look, we have PE, price to earning per share. So in this case, the price per share was 20 before split, and the earning per share, what was the EPS? 1.5. See here, this is the EPS. So earning per share was 1.5. So the PE ratio comes to be 13.33%. Similarly, here the price is now $10 per share and earning per share is 0.75. So this will also come to be 13.33. So this is also the same. And now let us look at market capitalization. So the market capitalization in this case would be, there are 2 million shares. So market capitalization would be, in this case, before split, they have 2 million shares for, and per share $20. So 2 million into $20 is equal to 40 million. So market capitalization is 40 million. Similarly, after split, what is happening? You have 4 million share and the price per share is $10. So again, market capitalization remains the same. It is 40 million. So this is how you can understand the effect of a 2-for-1 stock split, and this is how uh, different variables get affected, like number of shares, stock price, EPS. Okay, so that's that's the concept of stock split. Now what is the major difference between stock split and stock dividend? So in one side I'll write stock dividend, and in the other side I'll write stock split. So what is the difference? What is the difference? The difference between stock dividend and stock split is, in the case of stock dividend, there is transfer of retained earning to contributed capital, because in the in the case of stock dividends, it is showing like there is a dividend, the dividend payment is in the form of stocks, right? So in this case there is a transfer of retained earning to contributed capital. which is the amount equal to the stock dividend. Whereas in the case of stock split, no effect on shareholders account balance. So in the case of stock split, there is no effect on shareholders, because here the amount is moving to contributed capital. But in the case of stock split, there is no change from retained earning to contributed capital. So no effect on shareholders equity account balance. Okay, so this is the difference between stock dividend and stock split. I'll give it another color. Okay, so I'll highlight this as well, because it is confusing, right? Like, what is the difference between stock dividend and stock split? So this is the difference actually. Now, investors usually consider stock split a positive sign. So again, so that was explaining the difference. Now, investors usually consider stock split as a positive sign, as a as a positive sign for future stock price, because I guess more liquidity. So investors usually consider stock split as a positive sign for future stock price. The reason, it returns returns the risen risen stock price to a lower, more marketable range. So that's why it reflects as a positive sign. Okay, so now we saw 241 stock split. Now there are other types of stock splits as well. Like, it can be any uh, value. Like, other types would be some of the examples: 341 stock split, or 544 stock split, or 743 stock split, like this. Now, one thing to note is that stock splits are a decline in United States. So however, stock splits are in decline in the United States. Okay, now why is that? Because here we said the benefit is bringing the price back to marketable range, right? But now, since more and more mutual funds and exchange traded funds are there, they can split uh, the stocks into small fragments, and investors can buy it, right? So that's why, like, if you know, now you can buy small gold exchange traded funds for smaller price, right? So like that. So because of the greater use of mutual funds and exchange traded funds by individual investors, the transaction cost, because of the greater use because of the greater use of mutual funds and ETFs, there's a decline of stock split in US. Now, how is it benefiting? How is mutual fund and ETF benefiting? Because the transaction cost. Uh, so if you're buying equity shares in the stock market, you have to pay transaction cost, right? So this transaction cost can be considered as the commission paid for mutual fund and ETFs. So the transaction cost is considered as commission paid for the number of shares traded. Okay, and because of this, the concept of marketable range of marketable range becomes less important. Okay, so that's all for stock split. Now let us understand another concept. So till now we have covered all the five types of dividend payments as per curriculum, that is regular cash dividend, extra special or irregular dividend, liquidating dividend, stock dividend, and stock split. Now let us understand another concept, that is reverse stock split, which is exactly the opposite of the stock split. So reverse stock split. So what is a reverse stock split? It is opposite of stock split, which is it reduces the number of shares outstanding. Like instead of 2-for-1 stock split, now it will be 1-for-2. Like if you have two shares, it will be consolidated as one share. So reduces the number of shares outstanding, artificially increase the share price, increases the share price, because I mentioned the word artificially because it's not that the company value is increasing and because of that the share price is increasing, but it's like you're consolidating shares and due to that the share price is increasing. Now again in this case, no effect there is no effect on market value of the company, no effect on market value of the company, and there is no effect on no effect on market value. Second, there is, one second, I'll just move this. Yeah. So there is no effect on market value of the company, as well as there is no effect on shareholders' equity and total cost base. So there is no effect. So what is the objective? What is the objective of this reverse stock split? The objective of reverse stock split is to increase the stock price higher, increase the stock price higher artificially into a more marketable range, into a more marketable range. So it's like it's because some of the investors shy away from really low valued uh, equity shares, which we call penny stocks. So that's why sometimes to artificially to increase the share price to a more marketable range that investors actually buy, some companies use reverse stock split. So if I write it down, investors uh, at times shy away from buying too low priced stocks. Hence, hence, they can the companies can use reverse stock split to bring the price back to a more marketable range. Now, this reverse stock split is usually most common for companies coming out of a financial distress. Most common for companies which come out of a financial distress, because when they are in financial distress, usually their share price would fall really bad, and it might come to a really low price. So for companies that is coming out of financial distress, they can use reverse stock split to bring their shares back to a more marketable range. So now we are reaching the end of the video. So we can complete this section with the help of by solving an example. So by solving a question. So in this question, they have given, if a reverse stock split for a company was to take place, and it's taking place when the share price was rupees 8.25, find the expected stock price after a 1/410 reverse stock split. So in this case, they have given us that before the reverse stock split, one share is equal to rupees 8.25 Indian rupee INR. Now, uh, after a um, after a 1/4/10 stock split, it means that 10 shares will get consolidated into one. So it is the 1/4/10 stock split would be equal to the share price of 10 shares. So rupees 8.25 into 10 would be equal to rupees 82.5. Now this rupees 82.5 will become the price of one share after 1/4/10 stock split. Becomes price of one share. So that's all for this video. We have completed this section of the curriculum. Now you can go through the curriculum and solve the examples. That's all for this video. Thank you.